Hello and welcome to FidelityConnects. I'm Pamela Ritchie. In a post-COVID world, traditional market cycles don't really look the way they used to, and the old playbook may no longer apply. Are market cycles actually broken? One explanation our next guest raises is that perhaps Canada doesn't have an inflation problem, but we have more of an affordability problem, and which changes perhaps how we think about corporate spending, stimulus, and government debt. So how do we navigate this new landscape that is upon us, and what could change that narrative ultimately? Very happy today to be joined by Fidelity's Chief Investment Officer and Portfolio Manager, Andrew Marchese, for a discussion on where equity markets are today and what could drive them in the new year. We hope you'll join us in either official language. French audio interpretation is here with us. Andrew, great to see you. Happy New Year.
Great to see you. Happy New Year as well.
Very glad to have this conversation with you here today. Let's begin with that discussion of market cycles. It's often something at the beginning of the year you will have an opinion of, talk to us about where we are. What is messing with it at this point?
Yeah, for those who've heard me speak, I think over the course of the last year, I've been working with a hypothesis that largely due to the amount of stimulus in the monetary system, which goes back to the global financial crisis and beyond, the amount of capital kicking around there is enormous. And what it's actually doing is it's changing the boom-bust nature of both local, so let's call it a country or regional economy, and a more broader global economy. We don't have the boom-bust cycles that we have had historically. Now, a garden variety kind of economic cycle, you think of like a recessionary cycle that typically lasts anywhere from 5 to 10 years. So the early 80s and the early 90s would be kind of, symbolic of that. But the last cycles have been really caused by exogenous events or too much speculation, too much debt. And we keep curing those problems with more stimulus.
So
COVID was a big one. Global financial crisis was another one. And so we never extracted the capital out of the system. It just keeps growing. And that has an effect of now we go through periods of time where we're oscillating around 50. So both expansion and contraction in both manufacturing and service metrics, not only in the United States, but globally. So the market's paying more attention to the rate of change or a positive or negative inflection, as opposed to necessarily the magnitude of change, which was more commensurate with those cycles in the 80s and 90s. You would have a recession, you would have global profits recessing as well, and that would kickstart stimulus and whatnot to kind of cure the recession. And then you would have a 5 to 10 year playbook for the market that would involve, what leads at what point in the cycle, what sectors tend to do better or worse, how do profits kind of migrate through there, and obviously what we care about is how do equities behave.
Sure.
It's
early cycle, late cycle, mid-cycle.
Correct. Right. So now I think we're in an environment, and we could be for the foreseeable future, where sectors that lead are not typical based on where you think you are in the economy and you have this overarching secular theme of, in this case, innovation. So that would be AI.
Industrial revolution, essentially, going on at the same time.
Right. And that industrial revolution has second derivative, like increasing energy demand and things like this, which has implications for hard assets like copper and silver and so on and so forth. And so all these things don't follow the traditional playbook. So what I think it really requires us to do is really examine, what has worked, what hasn't worked, what risks are either priced for or not priced for, and where do we think better relative risk returns may be in the marketplace, which may not necessarily rhyme with history.
Okay, that is absolutely fascinating. There's a lot to sort of take apart there. So we, in Canada and a lot of other countries, ex-US, have pretty much come to the end of a rate cutting cycle.
Right.
Higher interest rates there to fight the inflation of all that money dumped into the economy to get us out of COVID, for instance, most recently. So soaking that all up, and now we're at a place that we think might be kind of normal or neutral, depending on how you look at it.
Yeah.
Again, ex-US. So should we be looking at the US and some of these other, we'll call them developed countries that have pretty much finished their rate cutting cycle, and the US, it's still kind of getting going to an extent. It's not is not at the end, we don't think. Are they in different places because of, cyclically where they are? Or in fact, are you saying this is being smoothed over by other events?
They're in different places from where they are in the rate cutting cycle. I'm not so sure they're that different in terms of where they are in their general economies. I think that's what makes, from a macroeconomic standpoint, and investors' reaction to what you're seeing in economic data a little bit more challenging, because we got all this stimulus, basically dating back to the second half of 2024, absent a real recession. Now, one has to ask themselves, is the AI boom and the CapEx spending associated with that actually masking a recession in the otherwise general economy? And there are people who believe that. There are people who say, no, that's not true. Even if you strip out the data, you have a mediocre economy, but you wouldn't have a recessionary based economy. So I think that's what's challenging for thinking about investing in the world. What we do care more about is the opportunities that present themselves globally. So you talked about US and ex-rest of the world. Well, there was a big thesis that some of our global fund managers had last year, that you could line up every industry, all 11 GIC sectors, and find rest of world securities that were invariably cheaper than their US counterpart.
And that trade took off.
So the rest of the world was cutting first, and by a higher order of magnitude. And even without the earnings following, because the economic effect wouldn't be felt quite yet, it takes a little while for those interest rate cuts to work their way through the system, the stocks reacted in kind, noticing that there was a valuation arbitrage opportunity, and earnings at some point in the future should positively inflect. So therefore, the relative value, so to speak, lied in rest of world. I'm talking the AI 8, but you certainly saw that, as I said, in most GIC sectors when you compared a rest of world stock to a US stock.
Is that continuing, would you say?
I think the valuation gap has narrowed, but if you look at Wall Street or Bloomberg consensus earnings estimates for this year and next, Wall Street estimates are forecasting in the S&P 500, 13% compounded earnings growth, profit growth this year and next. If you look at it for EFI, it's closer to 8-9.
Okay.
And so then you have to ask yourself, is the valuation discrepancy between EFI and the S&P 493, so take out the Mag 7, kind of justified? If you compare the PE to growth of those two categories, of those two groups of stocks, they're roughly comparable now. So the biggest portion of the arbitrage opportunity has probably closed up. That being said, I think we would all concur that whether you're talking about the S&P 500 holistically, the S&P 493, the MSCI ACWI, I don't want to say the market's expensive. It's not that. It's more expensive than it historically has been. And what I've said this for a year. Actually, last year I was wrong. You did get multiple expansion, but every time you expand your multiple from this point, it's harder. You're pushing on a string to a degree. So basically, what needs to happen is for the market to go up, earnings have to do the lion's share of the heavy lifting.
Okay.
So
they have to kick in.
Right. So if that 13% I talked about comes to fruition, if that EFI 9% comes to fruition, then the lion's share of the returns of the market should correlate to that or mimic that.
So that's so interesting. And some of the companies that caught that wind for all those reasons, because they were cheaper and so on, what's left in terms of the relative trade of perhaps different areas of the market? So, I mean, we saw certain areas of the European trade take off. We certainly saw the defense sector in areas where fiscal spending was going to be the greatest and so on. But there are still other parts of the economy that, in theory, if things are going to be okay for the economy, and we'll ask you about that, that we could now also look. And some of them actually are early cycles. So I was kind of asking about the disconnect there. What else is left to take a look at?
So if you look at last year, if you do a quick snapshot of last year in the rearview mirror, thematic investing kind of dominated. So if you think about, we talk about AI ad nauseum, But the second derivative plays on that in terms of data centers and energy consumption. You talk about nuclear, right? So you look at uranium, you look at copper, it's a direct drive on that. Copper, the commodity itself, and you look at the mining stocks were up huge. Defense spending, you mentioned, another thematic, basically based on changes that the U.S. is encouraging NATO to make. So thematic investing really dominated. And secondarily, if you look at post-Liberation Day, non-profitable companies in the Russell 2000 really took off. So there's a high degree of speculation on, kind of new science and innovation. What was kind of left behind, and you touched upon it early cycle, is if you go through a rate cutting cycle, which started in 2024, traditionally, if you had a crystal ball in 2024 and you said, if you knew how many rate cuts were coming and the order of magnitude and the drop in rates, 200 basis points rate, whatever it was, you would buy the halfway mark in those early cycle stocks. What does that traditionally mean? It means banks, but they already started taking off.
They've already had,
Housing, transports, autos. But if you think about housing, transports, autos, they had fundamental negatives going on.
Their own stories.
Their own stories, idiosyncratic stories where the market did not yet feel comfortable that the bottom was in. Why? Each of those three groups of stocks had negative earnings revisions continuing until the end of last year. Now, sometimes the market will see through that, but there was still a great degree or a lack of confidence that we've actually hit a bottom in terms of negative earnings revisions. If you look at the rails, just that railroad industry, for an example, the rail stocks have largely had 8 consecutive quarters of negative earnings revisions. So, the market never got comfortable that the revisions were going to end or what they would actually base out at. But you also had that compounded by a trade problem, right, with tariffs and how that affects autos, as we know. We're kind of in the crosshairs of that. And in the US, you have a housing affordability issue. So despite otherwise low rates, there's still an affordability issue there. And those three groups of stocks are correlated to the degree of about 70%. So there's a lot of stocks that have moved. Those three industries in general are interesting to me. I'm not suggesting they're a buy right now, but they're interesting because the earnings have been taken down. The valuations are discounted to the broader market. And we're still in a stimulative environment. In the US, you have fiscal policy that should start kicking in for both businesses and consumer this half of the year. And then monetary stimulus, which has occurred, plus there's probably more on the come. So if you look at that, I would be more interested in early cycle stocks and about a general economy, maybe on the margin, getting better.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Let's just layer up. There's so many political pieces to put to this story. We're trying to avoid some of them. But the idea of a march towards the midterms in the U.S. for many of those areas of so-called old economy, and they were in many cases voters of the Trump administration in a lot of ways, sort of left behind story within that political story. Do you see stimulus going into any of those for lots of good reasons as we go towards the midterms in the U.S.? Again, as an investment question, really.
It's an investment question, but I think it's also at the heart of it a political question in the sense that if I was a politician in the U.S. and I had say, and if I really wanted to show that I'm working for my people, the first thing I would try to address is housing. So whether that means more stimulus, whether that means you have to manage the long end of the curve, though. That might mean more QE, right? So we keep building up the money supply here.
That's really interesting because that is, in a market that is awash with funds and is still trying to soak a lot of them up, the liquidity story, to suddenly have QE come in, which you kind of did actually the last Fed announcement. We heard about that. So what's that for?
I equate, I'm going to put on my old pharmacy hat here for a second. It's kind of like
you're
when
a
you're
pharmacist. That's not your family, yeah.
So when somebody's sick and they take medication, sometimes you get side effects. And the right thing to do is probably try to change the medication so you give a better medication to get a positive outcome without the side effects. But the wrong thing to do is actually to take another medication to deal with the side effects. And you just keep adding medication to the patient. So they go from taking one drug to 5 drugs. And that's the wrong thing to do. I equate it to that. That's what we've kind of done with never taking the capital out of the system. So to your question, what can you do? Well, you just fix the problem with more liquidity.
Yeah.
And then you manage the long end of the curve to make sure, the long end doesn't go above 5. And we've been oscillating in a pretty tight range here for months now, So I think credit spreads it's been well managed. Yeah. Credit spreads are tight. Inflation's gotten better. All that money, M2 money supply, keeps growing the way it is. Eventually the inflation problem will come back again, and then you gotta cure it with temporary tightening and maybe something more permanent.
So let's ask a little bit about the top risks that you see. You've mentioned inflation there, and again, Bank of Canada, but also lots of countries around the world, so-called developed countries, have been saying for a long time, yep, we're gonna cut. Still concerned about inflation, but we're gonna cut. And so here we are, they're at the end of their rate cutting cycles. But there's now a discussion of hikes. It's lingering, it's not there around the corner.
No.
But what would you say your top risks are? I'm assuming inflation is in there somewhere.
I think if you look at the U.S., we'll start with the U.S. because it kind of, it's the linchpin of everything. You could say that we're pretty much at the natural rate of interest right now, if we take a snapshot right now. Now, historically, the Federal Reserve and any central bank would overshoot to both the upside in a tightening or a downside. So the market is expecting some continued cutting this year. I think if you see some weakening unemployment, as long as it's not too out of whack, that will be viewed favorably in the short term because it will give the green light for the Fed to cut, but it won't be so bad as to kind of have investors think that the economy is becoming derailed here, because we have priced in some success. So that's one thing. I think the inflation argument is probably somewhere down the road, and the US probably has a bias to cutting.
Yeah.
But the greatest risk, I think, to the market is actually the whole AI theme. I think it touches a lot more than people think it does.
So what does it touch? So okay, you've got obviously the Mag 7 or 9 or whatever you want to call it. That's that.
Yeah.
But actually they're probably untouchable in a way.
Well, here's the question. So, a lot has been made about the comparisons between AI and the 99.com bubble. It's very different from the perspective that the companies that were spending, the CapEx spending was basically done, basically at 3 to 4 times debt. The CapEx now is by the hyperscalers, being funded by cash flow, which is good. So you can say, well, it can endure. So why would the spending stop? Well, the spending would stop if the earnings become in question. So when you talk about these companies, you actually have to say, what's the biggest risk to the market? It's the companies who are doing all the spending. They get into a negative earnings spot, revision spot, where they got to curtail their spending.
That's why the heartbeat of the world stops at 4 o'clock when Nvidia's earnings are about to come out.
Right, exactly. And then there's other things that go along with it. So there's all the companies, in addition to the direct drive kind of picks and shovels, that benefit from CapEx, right? So the order of magnitude, if that were to ever occur, the order of magnitude on the multiples would be significant, because it's a crisis of confidence at that point, right, that this whole CapEx that we've been building up, this cycle that we're building up in our minds about this is the panacea of the future, somehow gets called into question.
So take that to Canada, and we'll talk about investing within Canada. It seems to a large extent the second derivative of the AI build out is what Canada is dealing with. It's everything to do with the picks and shovels in a lot of ways. We have some perhaps AI companies, but it's more about the energy side of things and various minerals and so on, and perhaps space for data centers and so on. How does this affect the Canadian economy? We can go more holistically into the Canadian economy, but just to kind of go in there about that discussion?
Well, I think the Canadian economy is really, as opposed to thinking about it in a innovative sense, and the minerals in the ground that we have are of strategic importance, and they will obviously help fuel the build out of data centers and energy requirements and so on and so forth. By which, and I didn't mention the other form of stimulus, which is like oil keeps going down, right?
Right.
And that's a huge one. That's another big one, to say that as long as that stays low,
you can power a lot of stuff.
You can power a lot of stuff, and you can fuel an economy, no pun intended. But I think with respect to Canada, what it really comes down to is government policy. And anybody who's listened to, I've said this I feel like a broken record in the sense that for 50 years, we haven't done enough as a country. And the trade war that started last year is a golden opportunity to us to further alliances with non-U.S. countries.
Yeah.
And
is that happening? It looks like there are some
I think
handshakes going on.
I'm consuming the same media that I think everybody on this call is consuming, so I don't think my opinion is any more informed than theirs, but it better happen. It should have happened yesterday. And I think that's what will make us competitive in the future. If we fail to do those things, then we can expect further problems, because we will be a country that is operating below our potential.
Okay.
But I think if you've heard the banks speak publicly that they're bullish on Canada, because it feels like last year was that Minsky moment, so to speak, to get us moving in the right direction. And you have to take that as a positive. How quickly things will evolve. You got to remember, this is going to be a multi-year, multi-decade type of movement.
Can it be that for the TSX? Because it was a pretty fabulous year last year.
Yeah.
Can we have to turn that into a 5-year, 10-year?
It's I think on the it's very interesting. I look at it this way. Artificial intelligence is a page 1 story.
Okay.
The hard asset theme, of which Canada is known for, is still a page 16 story. Normally, in the world, you make more money from investing on page 16 than you do at page 1. Right. So what you want is a story going from page 16 to page 1, so to speak. Right. So I think
some listeners don't even know what that means.
Well, the point is the whole commodity complex. Well, let's take energy out of the equation because it's a little more complicated. But there's less places to invest than there used to be.
That's really interesting.
Like we lost a lot of companies in Canada in the mining sector. If you think about the knots where we had that whole boom, Go Canada boom, there was a lot of M&A. A lot of companies got acquired, industries. There's not a lot of places to invest anymore. The resources in the ground, as you've heard from basically every politician globally, are more valuable than they used to be. You're seeing actions taken over the last 12 months where nations are trying to commandeer resources in the ground. This isn't just a 12-month, 24-month exercise. This is going to be, a multi-year kind of exercise. And so what does that mean? Things in the ground in Canada become more valuable.
Are we page 16?
I think we're page 16. I think we're page 16, maybe moving closer to page, 12 or something like that. But we still got a ways to go. Yeah, but we still got a ways to go. So that to me is more interesting for those on the call who have heard people like Hugo Lavallee recently. He's been talking about the hard asset theme, and he and I have been talking a lot about it and what this kind of means kind of going forward. So yes, digital, AI, all very exciting, not going away anytime soon. But from an investment perspective, there's certain things that are going to get dragged along with it.
So, you mentioned there are less places to invest in Canada, just fewer companies, which is true. And there was a period of time where, even investment and financiers would have a company named XXX Commodities, and they flipped to something else because, that sort of fell out. Yeah. We'll see more of that happening too, right? In theory, there will be more companies created to address essentially what's in the ground. Is that what we're saying?
Maybe, or there'll just be more M&A, and it will further kind of go into the hands of fewer, larger people.
Governments?
It started, right? It started in the U.S., and so given the rhetoric that we're all hearing in the media, there is a desire for governments to commandeer resources in the ground.
How are you leaning into Canada in terms of positioning, in terms of broad strokes of how you're aligning yourself with Canada versus the rest of the world? There's a question coming in about your thoughts on Japan.
Well, Canada, I think, just from kind of comparing Canada to the rest of the world, the resource aspect is exciting. It's not going to be a straight line. It's going to be very volatile. There is a lot of fast money in this stuff as well. You've seen it in things like silver, right?
Okay.
If anybody has watched the chart of silver over the last little while,
better than gold. Yeah.
Much better than gold. Can you really explain it on a supply-demand basis? Because at the end of the day, silver is really an industrial commodity. You probably can't. So things are going to be fraught with volatility. I think the person was asking a question about Japan. I don't have a strong opinion on Japan. Japan has been notoriously cheaper than the rest of the world, but reflating at this point in time.
Yeah.
And I think, if I had to kind of survey some of our global PMs around the complex, I think there's generally a positive bent towards Japan.
Sounds like it.
I can't specify any one industry or sector, but generally going in the right direction.
And a question on trade, because it is going to be, it looks like one of the biggest questions for Canada going forward, because we have to renegotiate NAFTA or whatever we call it. And it looks like the global trade discussion is shifting. I mean, Venezuela is a piece of this story, and maybe Greenland as well. But there are global shifts. Again, how do you sort of lean into that? How do you invest around it? Do you need to invest around it? Maybe you don't.
No, I think it's very difficult to predict with any degree of confidence, where you think a bunch of government officials who meet around a board table and eventually come out with some kind of policy or deal in place, and what that, I think you do your best to kind of, understand what could be the potential risks, what could be the potential upside, and if the price seems right to you, if you're kind of comfortable with that risk-reward backdrop, you invest accordingly. I don't think it can be that more finer than that. I think there's too many unknowns and too much uncertainty to go, start pounding a table on any one thing, but you monitor it. Price is probably your best predictor of the course of action you should take.
Okay.
And that's what I think. And that's what cycles are all about. Because typically when you buy cyclical stocks, you think about when you buy them. You start buying them during a recession. What does that mean? You open up the paper in the morning and the headlines seem awful. Right. So it should feel awful when you buy them.
Right.
That's actually the right thing to do. So the last thing you want to do is buy them when it sounds too good to be true, because it probably is.
So then let me ask you this with a minute to go. If there are concerns, because you mentioned AI, risk, exposure, and so on, if AI has a real stumble, is Canada a good place to be to minimize the damage?
It's a tough question, because I think if you decompose Canada, you look at the resources area, like we have been bearish on the price of crude, and I think the recent actions in Venezuela, as well as the general backdrop in the supply market for oil has leaned towards lower prices, and we said that last year, and all that's still in play. And last year I remember saying, in February of last year, saying the one thing that about Trump, and which he's always been consistent on in that administration, they want lower oil prices.
Yeah, they are getting them.
And they're getting them. They're going to find every way to get them. So that's not great for Canada. The trade between the U.S., Mexico, and Canada, that will probably be put on the back burner a little bit with recent kind of national, global issues going on. Right. And so a resolution on that front may be postponed a little bit. So it's hard to say there. That affects the banking sector. Okay, but I think people are generally bowled up on banks. They've been very good stocks because of what I said earlier. The long term is maybe Canada starts investing in its own country and building things. and so on and so forth, and strikes international trade alliances with other countries where it hasn't had before.
So does it feel awful now and you should be buying?
It doesn't feel awful because we've had a really good stock market for a long time, right? And as I said, we got stimulus coming. So I'm more worried about, when things are good, the returns are good and everything, that's when you don't sleep as well.
Right.
When things are bad and in your face, you're like, well, at least I know what I'm dealing with.
Okay.
So when things are good, you're always kind of looking for what's going to jump out of what's out of a closet, or what's sleeping under the bed what monster's underneath the bed that you forgot about. Those are the things that, so you're more hyper aware actually when things are good than when things are bad. Okay. When it's bad, it's in your face.
Okay. So you know what you know at that point.
Yeah.
Andrew Marchese, fantastic to get your views on the marketplace, Canada and the globe. Thank you for joining us.
Thank you.
Happy New Year.
Happy New Year.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.